welcome to the Conquer Risk podcast from Potomac. My name's Jeff. I've got my business partner Manish here. And, it's interesting. We're going to cover a lot of different things over the life of this podcast. But one of the items that we obviously forgot last week was who in the heck are we? Why are we even doing this? So, Manish, you want to give a little bit of background as to what it is that you're bringing to the table, your experiences, that sort of thing?
Yeah, anytime you do your first podcast, you always look back and say, what did we do wrong? And some of the feedback we got is you never actually introduced yourself. So I'm the president and chief investment officer at Potomac Fund Management. First job out of college, 17 some odd years ago, hired to do trading operations, develop systems, was mentored by the vice president at the time, Mark Palomares, who sort of showed me the ropes. And over time was lucky enough to purchase incremental shares of the company. And a couple of years ago, bought out majority share. So I'm a lifetime Potomacer, however you want to say that. I don't know if that's good or bad. This is my only sort of real world experience. So,
hey, just for the record, we make up words here too. So
exactly.
It's all good.
So yeah, it's the Kool-Aid is in my veins. I haven't done anything else. And so, I'm majority owner now, obviously with you as my business partner and trying to take the company sort of forward in a different path here.
Yeah. No, that's good stuff. And that's why you and I are sort of a yin and a yang. I mean, I've done a lot of other things. So my whole career has been in numbers, right? I started, 26 years ago in a couple of banks right out of college. And then went to a firm, American Century, Security Benefit, and then learned life insurance, mutual funds, annuities. Moved to American Century, worked with the larger advisors there. Was on the help desk, did a lot of web work. Really worked with the brokerage team, getting that up and running, and then moved on to a firm called VSR, where I really dug into the advisory side. And it was like that was the epiphany for me. Like, wait a second. There's a lot of different things that you can do, and advisors can do a lot of different things. But for me, the advisory side is where I really dug in, and I spent over a decade there, about almost 13 years, doing due diligence on third-party managers like Potomac. That's how you and I met. Was the fact that you were a third-party manager, you were a vendor that I had to approve, and we started doing business, and obviously built the relationship to the point where now I'm here, and I'm a minority owner. So. Yep. That's the benefit here, right? You've got two owners talking about our experiences, our journey in running an RIA.
Yeah, fair enough. Working with advisors our whole lives, so I think adds a lot of value there.
Yeah. Well, so there's a little snippet about the background. So now we need to move on to some of the other topics along the way. And one of the things that we wanted to talk about was actually, this is really your bailiwick. Is apparently you visited the Riskalyze Bootcamp recently, not too far from your where you're currently living. You want to speak about that?
Yeah, and so Riskalyze Marketplace is a marketplace of money managers where you have the ability to get research and trade signals, and we recently signed up, as you and I have been trying to put the Potomac strategies in the hands of as many people as possible. And so after signing up for as a strategist on the marketplace, I wanted to go up to the boot camp and shout out to Riskalyze for throwing such a great event and learn how advisors are using it. Since we've worked majority through advisors, it's hard for us to sort of understand how they're using it with the end client. And that was important because I wanted to see how they use it, how we can play a role in that, and how they can see our strategies. So it was actually, they went into detail about the system, how the score is calculated, best practices, and sort of what they have on the roadmap, which is a huge focus on autopilot, which will benefit us selfishly because we have the ability to put those trades in there. So definitely a good experience. I don't know what your thoughts are so far in working with them.
Yeah, it's definitely an interesting perspective. I mean, I would say point blank, it's pure genius creating the speed limit sign, right? I mean, ultimately,
yeah, for sure.
That is such a simple concept, even though there's all kinds of math behind the equation. The fact that a speed limit sign is so simple for clients, the end client, to understand. I think that's absolutely brilliant.
Well, I mean, listen, how about just us, right? Because when we're explaining strategies, we're like, hey, to us, this is our most aggressive strategy. However, that doesn't really mean anything because people
Right.
build books of businesses with different strategies. It doesn't. So just being able to say, look, take this independent third party. It's out of our hands. We're not classifying anything. Take that score for what it's worth. It put things, it levels the playing field. Really, there's not a lot of hanky panky going on with people trying to classify things their own way.
Right. Yeah. Well, like I said, that's really the deal. If it's easy for clients to understand, they're more likely to engage and more likely to accept. Right. And that lends itself well because ultimately, and you said this last week, right? I mean, if you're going to try and control risk or conquer risk, then you're going to potentially give up a little bit of return, right? Because there is no silver bullet. So
Well,
if the
hold
client
on. Are we
understands,
gonna? I think we need to admit that, for full disclosure, that we were Riskalyze haters years ago.
well, that's true. That's true. And part of that is just because we are tactical and unconstrained managers. That's so because of your conversation with one of the founders. Maybe you can touch on that, right? How is a tactical unconstrained manager affected with or by Riskalyze and the scoring process?
Well, when we started with Riskalyze, they actually didn't have a category for tactical. And so what would happen is you could have a manager like Potomac who could be 100% invested one day and then 20% invested or 0% invested. And if you start adjusting risk scores on the fly like that without accounting for the tactical nature of trading, it doesn't set the proper expectations. And so from starting off, I didn't really understand how they were calculating the risk score. And they had come out with a tactical version, from what my understanding is, incorporates more traditional tactical statistics like max drawdown, batting average. Because things like standard deviation, they don't account for the higher highs and the lower lows. So you need other statistics that really help encapsulate drawdown. And so they came out with this other category. And I think, to their credit, they've really sort of expanded on how they score strategies. And so, yes, we weren't fans at first, and we've slowly become fans of the process. And now, in the last couple months, meeting everyone, from marketing to the owners to even the product team, it's the brand. There's such a brand fit with who they are and who we are. I'm pretty pumped about working with them.
Yeah, I would agree. It's always fun when you actually get to talk to what I call good people. Right? I didn't get the sense of the slimy salesman concept, which in our industry obviously is a prevalent problem.
Well,
But
especially in fintech.
yeah. Well, and one of the things that I want to touch on too, just briefly, is the fact that I made a statement a moment ago. Right? If you want to conquer risk, you have to give up some return, and I think that needs some clarity because ultimately, I think in the short run that may be the case. But when you look at the results long term, where you start to see full market cycles, when you can lop off a little bit, if a little bit of the top gets lopped off, but you're also mitigating that bottom risk, that hidden risk, that catastrophic risk, the average annual returns aren't necessarily going to be any terribly worse or any worse than some of your what I'll call normal or strategic investments. It's a matter of simply being a different ride. It is a different path, and therefore the word I like to use is a different experience. So I want to clarify that because I don't want I want folks that might be listening to think, oh wait, okay, so they're already telling me they're going to suck most of the time, but they're going to save me from risk.
Well,
That's not the case.
There's no risk. Bull markets last forever. Let's move on to the next
Oh
topic.
wait, it's different this time. There we go.
No,
We had to throw that in there
we're
just
in
once.
we're in the middle of a 100-year bull.
There you go. All right, so that lends itself to, I think,
I'm
the
joking,
next
by the way.
yeah I think it lends itself to the next topic, which is a recent blog post. This is a blog post that you wrote, and it's got a long history between you and I, since we've known each other so long in our roles, right? Hypothetical is industry code for hogwash. Great blog,
I wanted to
by
say
the way.
bullshit, but Jennifer wouldn't let me.
Yeah, well, I think frankly, my stance long before I came here that I would completely agree. I mean, doing due diligence for so long, that's one of the things I was looking for. I was looking for ownership. I was looking for disclosure. I was looking for all these things that are in the background to validate whether or not the performance numbers that I saw were A, real, and B, matched the experience and expectation based on what I was told it was supposed to be, the marketing literature was, etc. So let's start with the reason that I wanted to talk about this week is in the last week and a half, I've had 3 different advisors bring to me something that turned out to be hypothetical in nature, or start asking questions in regards to, in this case, one of them was in regards to, some signals and those sorts of things. And that's a real differentiator for us. The signals that we're providing through Riskalyze Partner Store are the same models that we're managing real advisor client money. And I think that's a very important distinction. So anyway, let's rip through this just a little bit. I want to start with the test that I put you through down in Florida. You want to speak to that a little bit? I kind of put the heat on you.
I know, I don't know if one of my passions, I don't know if this is a passion, maybe not, but is going through track records and one of our advisors used to, I love the quote, there has to be a pony in that pile of poop. And I like going through track records to figure out what's sort of where the details are, because over my years of creating strategies and looking at strategies, I've found that there's a lot of hocus pocus when it comes to creating smoke and mirrors. F Squared got busted years ago for, creating a misleading track record. And it still goes on today. It's so prevalent. So when you were down in Florida with Kim, your wife, I said, look, I popped open my laptop. I said, give me 30 minutes. I think I finished it in 15. I said, I'm going to create a hypothetical track record on my software system that goes back and tracks, buys and sells, and creates a performance track record. And the kicker is I can actually put this in a fact sheet and sell it to clients. It's perfectly legal. And it rubs me the wrong way, because there's times where we lose business, most recently to a billion-dollar firm who is on one of the largest BD's platforms. And I'm not going to name any names, but I go in there and I see a track record back to 1991. Wow, it's impressive too. And then I started reading the details. The real actual account performance didn't start till 2016. So from 91 to 2016, it was complete bullshit. It was just made up. And that's what hypothetical track records are to me. You are back testing using indices that frankly may have not even been around, right? To your point, you did some research on the amount of funds that have come and gone. Touch on that, and we can add that in.
Sure. Well, so the number of funds, this is from the Investment Company Institute, and we'll provide a link in the notes so that you can go through this. There's a lot of good information in here, but I think it's interesting that, number one, I'll hit on the number of funds that are available. In 1999, there were 6,834 mutual funds. In 2018, there were 17,707 mutual funds. Just that alone should boggle the mind enough to think, okay, I'm an advisor and I'm managing portfolios and I've got to divide up my time. Well, it has got extensively more complicated, because 17,000 funds, I mean, just to filter through those alone is a full-time job, right? But here's something that I found intriguing, and that is, and again, this is another chart that we'll display here in the same report. The number of mutual funds and ETFs leaving the industry. We are now at 2017 and 2018 and in fact, even 2016. These are the most funds and ETFs exiting the industry since 2008.
Okay. Can I stop you right there? I want to stop you right there. So think about it. You have a manager that trades ETFs and trades 10 ETFs, right? And they have a hypothetical track record. Those ETFs didn't exist in 91, in 2000. So what are you testing against? They're testing against indices that go back, approximating what the ETF would look like. You just can't do that, and it's living without regret. If all of us could go back in time and do something differently, we probably would. But these track records assume that you would actually execute it on that day to the exact amount. And to your point, half these funds didn't even exist. So it's just bullshit.
It's bullshit. Yeah, well, that's
I mean,
the
how do
thing.
we put a stop to it? I was on Twitter the other day, and Med Faber, who I follow, was calling out a firm and talking to the SEC, or I don't know if I'd ever take it that far, but it's such an accepted practice, I guess, these days, or maybe no one knows, or maybe no one cares. I don't know.
Yeah, well, that's really part of the problem. The fact that it is legal is really where the problem is, and there's not. This is my issue. I would, although I don't like it, I would even be okay with it being legal if there was a standardized way that was painfully clear to display hypothetical. And let me give you a quick example. If you think of the mountain chart of performance that everybody wants to display, if there was a vertical line that distinguished the hypothetical versus the real, it would be painfully obvious for anybody that looked at it what
Well,
was
Jeff,
actually real.
technically,
Yeah.
you're supposed to do that.
Yeah, well, look,
Yeah.
obviously you don't have to. I mean, the SEC isn't coming down hard on anybody for this. Otherwise, we wouldn't be having this conversation right now. But I mean, that's, it is what it is. I mean, yeah,
Well, so
effectively,
let's.
I'm going to read an example. Go ahead.
Go ahead. Yeah, go ahead.
All right, so I'm going to read an example, and this is from your blog post, but there are several, and I want to read one that I think it's.
Well, before you get started, let's just touch on what the blog was we decided to make an actual fact sheet. So I ran the hypothetical, and you and I sat down and said, all right, let's make an actual fact sheet. It's called the DUH portfolio. Do not use hypotheticals. And we went through and we listed the performance. We listed some descriptions, and then also a disclosure. And the disclosure that you're about to read from, we pulled actual pieces of disclosure that we had read from other pieces. So just some background. Go ahead, Jeff.
Yeah, so this is one of my favorites. This is a quote from another manager's piece. So I'm reading this verbatim. Some of the mutual funds used were not available until X date, making the hypothetical results unattainable during that time. I mean, I don't even know where you go from there.
Shit, Sherlock. Thanks for letting us know.
Yeah,
But we'll report it and sell it to you.
Yeah, well, I caught the world's biggest bass. It was 500 pounds, but I didn't have a camera, so I mean,
take my word for it.
Yeah, take my word for it. It was huge. So yeah, I mean, when they admit that it's unattainable and yet they're going to display it to you, what that tells you. And by the way, I do have a psychology degree. So I take a little different stance. I sort of joke that I was behavioral psychologist and behavioral finance before that even existed. I'm that old. But the concept is that the picture, right? The old adage is a picture speaks 1,000 words. The picture of performance speaks so many more volumes than all the disclosure that the SEC wants to have you put in. Because nobody reads the fine print. Nobody reads the prospectus. Nobody reads all these disclosures and things that we have. Nobody reads them. Otherwise, you would get things like this, which, hey, this is a really cool picture. But by the way, it's unattainable. And the fact that you can say that in a disclosure, here I go on my rant. You can say that in a disclosure, but you can still show them the picture anyway. Well, about that 500-pound bass, let me sketch a picture of what it looked like. And then I'll just write below it, this isn't actually the picture. But look at this huge bass I caught. I mean, it goes back to bullshit. So anyway, there we go. Soapbox.
What else?
You
got any other fun disclosures in there?
Yeah. So there's another one. Let's see. What do we got here? Hypothetical results were obtained by using the actual indices, prices, and/or funds similar to funds currently used. Similar.
Yeah. And that's, who's defining similar is, and that's all left up to the imagination. Indices change over time. Right now the world technology index is, I think, 60% US. It was that the same years ago. I mean, anyway, we got to move on.
Yeah. So one more thing here. And this is something you wrote in I think it was a commentary. So our active advisors of any sort, whether it be subscribers to our signals, our platform advisors, or our direct advisors, would get our market commentary. And I think it was one of those that you referenced. There are more, I believe it was 2012. We'll have to go back and look. There are more indexes now than there are stocks to invest in.
Yeah, I mean,
That blows
anyone
my
can create
mind.
an index. That's the
Yeah,
new
blows
smoke
my
and
mind.
mirrors. But
Right.
anyway, any
So,
other
all right.
disclosures?
No, I think we've probably beat that
Okay.
horse enough. So, all right.
So
So moving on.
recommendations.
Yeah. You want to fire away? You want me?
Yeah, I recently my wife and I watched Theranos, which I've heard a lot about, but we never got around to watching it. It was slow and sort of dry, but what a strange creature that lady is with the black pantsuits, and I mean the fact that she misled so many people. And my takeaway really from that was, when you stay private longer, which more companies are doing now, you can get away with a lot more. You don't have to be accountable to shareholders.
Right.
And so when I walked away from that, I thought, how many other companies out there right now don't really have a product and they're just selling hopes and dreams, getting private equity, and, may never come public. And if they do, that there may be a lot of skeletons in the closet there. So it was a good watch. I'm not sure it's a high recommendation, rainy day.
Now you told me last week that these recommendations, I mean, they got to be spot on. So now you're giving me one that's mediocre. Come on,
Well,
bro.
yeah, I mean, I would, yeah, I probably wouldn't spend the time. But what you got?
It's actually, honestly, it's a fitting one on the day that we're talking about hypothetical.
Yeah.
So there you go. I understand why you put it in there. I'm going to go with one that you said you watched as well, and that is, I guess it's Prime, one of their special series. It was only, I believe, an 8-part series, but it's called The Widow with Kate Beckinsale. And I got to say that I was first, I saw the trailer and I was like, okay, this looks pretty cool. I was really shocked because I don't remember ever really seeing her in anything else. I mean, a beautiful lady, but
very easy on the eyes for sure.
Yeah. Well, she strikes me more, and this is right. This is your scratch judgment, which that's what people do. That's just natural. Okay, she's sort of model type. I'm a model-ish. I was not expecting, and that's what blew me away. This show really gets down and dirty. I mean, it's a lot of action, super high intense drama. And I mean, she's getting her hands dirty. She's doing.
It was a
binge
watch kind of show, right?
Yeah.
I think I knocked out 4 or 5 episodes at once.
Yeah, the 8 episodes was gone in about 3 days for us. It's
yeah,
like,
I keep
wait,
logging in, checking for season 2, but I don't know when the hell's coming out.
Yeah, I know. So anyway, I highly that definitely that'll kick it up a notch. If you want a short bingeable series, that is absolutely worth the watch. It's one of the best I've seen in probably the last year.
Awesome.
So
what else we got?
All right. So I think that pretty well covers it for today. We've talked about the Riskalyze Bootcamp. We've talked about hypotheticals, hogwash, and our blog post that you're welcome to go read out there. We'll provide a link, and obviously some good recommendations to be able to walk away with in some form or fashion. So like, subscribe, obviously share the podcast, dance your own beat, whatever it takes. We want to make sure that we know. Oh, by the way, here's a thought. We also now have released our first podcast, right? We did it in audio first to the Google Play, Pippa, Libsyn. We're still working on Apple Play, the iTunes store. That takes a while. But we also have the video version out on our YouTube channel. And so that will start to become part of the process. We'll release the video as well. And hence the reason that we've referenced that there's a couple of charts that we will show as well as link to, so you can see those on your own on the cord. So yeah, definitely like, share, subscribe. I mean, that's what we want to see. We want to find out what more everybody wants to hear us talk about in our journey owning and running an RIA.
Thanks. We'll talk soon.
All right. Adios.
Later.